You woke up this morning, you made coffee, you checked your phone, and without realizing it, you touched the global economy about 11 times before you even left your bedroom. The coffee, grown in Ethiopia, roasted in Germany, shipped through the Suez Canal. The phone, assembled in China, designed in California, running on cobalt mined in the Democratic Republic of Congo. The electricity that powered both of them, priced by a market you've never seen, controlled by people you've never heard of. You didn't choose any of this. You were just born into it. Let's go. 1. The foundation. What an economy actually is. Here's the thing. Most people think an economy is a thing, a place, something you can point at. It's not. An economy is just millions of humans, each wanting stuff they don't have, trading with other humans who also want stuff they don't have. That's it. You want a haircut. A barber wants dinner. A chef wants a phone fixed. A repair tech wants a haircut. Money is just the middleman that makes the chain work without everyone having to find a perfect swap partner. That's called the medium of exchange problem, and money solved it around 5,000 years ago in Mesopotamia. Money is economic lubricant. It keeps the gears spinning. Without it, you'd need to find someone who both has what you want and wants exactly what you have. Good luck. Now zoom out. One person wanting a haircut is just a want. Millions of people wanting haircuts simultaneously, that's demand. Millions of barbers deciding how many haircuts to offer and at what price. That's supply. Supply meets demand. A price is born. That's a market. And markets don't just exist for haircuts. They exist for oil, for currencies, for government debt, for the right to pollute, for human attention. Everything you can imagine has a market. Some of them you've heard of. Most of them you haven't. That's the foundation. Moving on. 2. GDP, the number that runs the world. Because markets exist everywhere, someone needed to measure them. So economists invented GDP, gross domestic product. The total value of everything produced inside a country in 1 year. In theory, GDP tells you how healthy an economy is. In reality, it tells you how busy it is, which is not the same thing. Japan spent $6 billion rebuilding after the 2011 tsunami. GDP went up. Congratulations. Destruction is growth, apparently. Here's how it actually works. GDP has 4 components: consumer spending, business investment, government spending, net exports. Add them up. That's the number every government on Earth obsesses over. Every central bank watches it, every election turns on it, every recession is defined by it. 2 consecutive quarters of GDP shrinking. The United States GDP in 2023, $27.4 trillion. China, $17.7 trillion. The entire continent of Africa combined, roughly $3 trillion. That gap is not natural. It's historical. It's structural. It's the legacy of centuries of extraction. But that's a whole separate script. Right now, understand this. GDP going up doesn't mean you're getting richer. It means the economy produced more. Who captures that production? That's the question GDP doesn't answer. 3. Money, banks, and the machine nobody explained. Now, you know what an economy is. You know how we measure it. Here's where it gets uncomfortable. You have $1,000 in your bank account. You think that money is sitting in a vault somewhere with your name on it. It is not. The moment you deposited it, your bank lent most of it to someone else. That person bought a car. The car dealership deposited that payment in their bank. Their bank lent most of it out again, and again, and again. Your original $1,000 deposit, through a process called fractional reserve banking, can generate $10,000 or more in total loans circulating through the economy. Banks are legally required to hold only a fraction in reserve. In the US, reserve requirements were effectively set to 0 in 2020. 0. Banks don't store money, they manufacture it. Here's the problem. That manufactured money is debt. Every dollar created through lending is owed back with interest, which means the economy structurally requires constant growth just to service existing debt. Stop growing and the system starts cracking. That's not a conspiracy theory, that's the math. And the price of all that money? That's interest rates, set in America by 12 people sitting in a room at the Federal Reserve. Raise rates,
borrowing gets expensive, economy slows. Cut rates, borrowing gets cheap, economy heats up. They're essentially the thermostat for the entire US economy,
which, because the dollar is the world's reserve currency, means they're partially the thermostat for the entire planet. 12 people. Entire planet. Let that land. 4. Inflation, the tax nobody voted for. So prices start rising. That's inflation. And here's where it gets personal. Inflation isn't just prices going up. It's your money going down. Your $1,000 in 2000 could buy what $1,780 buys today. You didn't lose that money. It just quietly evaporated while you weren't watching. In theory, a little inflation, around 2%, is healthy. It encourages spending over hoarding. Businesses invest, workers get hired. In practice, the moment it tips past healthy, it becomes a wealth-destroying machine that hits the poor hardest and the rich least. Why? Because the rich hold assets, stocks, property, businesses that inflate with rising prices. The poor hold cash. Cash loses value. Assets gain it. Spoiler, the system isn't neutral. Now let's talk about what happens when inflation goes completely off the rails. That's hyperinflation. And for that, we need to go to Zimbabwe.
Robert Mugabe's government needed money. The treasury was empty. The solution was simple and catastrophic: print more. In 2007, Zimbabwe's annual inflation rate hit 66,000%. In July 2008, it hit 231,000%. By November 2008, the Reserve Bank of Zimbabwe issued a $100 trillion bill. $100 trillion. You couldn't buy a loaf of bread with it. Prices were doubling every 24 hours.
Workers demanded to be paid in the morning because by afternoon, their salary would be worth half as much. Doctors stopped coming to work. Teachers stopped teaching. The entire formal economy collapsed. Farmers abandoned their land because it cost more to grow food than the food was worth. Supermarket shelves went empty. People carried cash in wheelbarrows, not because they were rich, but because a single transaction required that much paper.
A bottle of cooking oil cost 100 billion Zimbabwe dollars. A coffin, which was in high demand, cost 50 million. The government kept printing. The central bank kept issuing new denominations with more zeros. By early 2009, Zimbabwe abandoned its own currency entirely. The US dollar and South African rand became the de facto money of the country. The Zimbabwe dollar, after all that printing, was officially worth nothing. The moral: a government that can print its own currency can also destroy it. Money is only valuable because everyone agrees it is. The moment that agreement breaks, and it can break, you're not holding savings, you're holding paper.
5. Trade. How countries get rich and exploit each other. Back to the chain. Zimbabwe's collapse didn't happen in isolation. No economy does. Every country is connected to every other through trade, and trade is where the global economy gets complicated fast. Countries trade because of comparative advantage, an idea Ricardo formalized in 1817. Even if one country is better at making everything, it still benefits from specializing in what it makes most efficiently and trading for the rest. Sounds clean. In reality, it's how richer countries locked poorer countries into producing raw materials for centuries while capturing all the manufacturing value themselves. Here's the thing about trade. The product that crosses the border is just the visible part. The real exchange is productivity, technology, jobs, and sometimes dependence.
China became the world's factory, not because Chinese workers are cheap. That's a lazy answer. It's because China built infrastructure, trained engineers, mastered logistics, and kept its currency deliberately undervalued for decades so its exports stayed competitive. By 2023, China exported $338 trillion in goods. The US imported more from China than from any other single country. Meanwhile, the US runs a trade deficit. It imports more than it exports, and has since 1975. In theory, deficits are bad. You're sending money out faster than it comes in. In reality, the US funds its deficit by issuing treasury bonds that the entire world wants to hold because the dollar is the global reserve currency. The US essentially pays for imports with paper, dollars, and debt, and the world accepts it. That's not free trade. That's a structural privilege built after World War II and maintained by geopolitical leverage ever since. Plot twist. The global trading system isn't a level playing field. It's a game where the rules were written by the people who were already winning.
6. Financial markets, the casino that runs on top of the economy. Now here's where most people get lost. Above the real economy, the one with factories and coffee and haircuts, there's a second economy, the financial economy. Stocks, bonds, derivatives, futures, options, currencies. It moves faster, it's louder, and it gets most of the news coverage. Here's what stocks actually are. A company needs capital to grow. It can borrow it, that's a bond, a debt,
Or it can sell ownership, that's equity, a stock. You buy a share of Apple, you own a tiny fraction of Apple's future profits. In theory, stock prices reflect the underlying value of a business, its earnings, its growth, its assets. In practice, in 2021, a Reddit forum called Wall Street Bets collectively decided to buy GameStop, a dying video game retail chain, and sent the stock from $17 to $483 in 3 weeks. Not because GameStop suddenly became valuable,
because enough humans believed enough other humans would believe it would go up. That's not investing. That's a belief cascade. That's a crowd. Here's the brutal math. The financial markets have grown so large, they now dwarf the real economy. Global stock market capitalization, roughly $109 trillion in 2023. Global GDP, roughly $105 trillion. The casino is bigger than the economy it's supposed to represent. This matters because financial crises, which happen in the casino, destroy real lives. In 2008, banks packaged garbage mortgage loans into products they called investment-grade securities, sold them globally, collected fees, and when the loans defaulted, the entire system seized. The US lost 8.7 million jobs. $19.2 trillion in household wealth evaporated. The banks got bailed out, the bankers got bonuses. Right, moving on. 7. Inequality, where the money actually ends up. Here's what all of this creates at scale. The global economy in 2024 produces more wealth than at any point in human history. Global GDP per capita, if you divided all production equally, is around $13,000 per person per year. Not rich, but survivable, stable. Except it's not divided equally, not even close. The top 1% of global wealth holders own 45% of all global wealth. The bottom 50% own 2%. Oxfam reported in 2024 that the 5 richest men on Earth doubled their fortunes since 2020, adding $465 billion, while 5 billion people got poorer. This isn't happening because rich people are smarter. It's happening because capital compounds. You have money, you invest it, it makes more money, you invest that, it makes more money. Meanwhile, you have a salary, you spend most of it on things whose prices are rising faster than wages, and you save what's left in a bank account earning 0.5% interest while inflation runs at 4%. The system isn't designed to help you. It's designed to extract from you. Understand that. Plan accordingly. 8. Zoom out. The whole machine at once. Let's zoom out. You started with one person wanting coffee. Now you can see the whole picture. 7 billion people wanting things they don't have. That's demand. Businesses competing to provide those things. That's supply. Money lubricating the exchange. That's currency. Banks multiplying that currency through lending. That's credit. The price of credit. That's interest rates. The result of too much credit chasing too few goods. That's inflation. Governments trying to stabilize all of it through spending and taxes. That's fiscal policy. Central banks trying to stabilize it through interest rates and money supply. That's monetary policy. Countries exchanging surpluses and deficits. That's trade. The financial layer pricing risk and future value on top. That's markets. All of it creating winners and losers in amounts so asymmetric they would be illegal in a fair game. That's the current world order. Every single piece connects. Pull one thread and the others shake. Here's what nobody told you. When the Federal Reserve raised interest rates from 0.25% to 5.5% between 2022 and 2023, the fastest rate hiking cycle in 40 years, it didn't just make US mortgages more expensive, it made the dollar stronger, which made dollar-denominated debt more expensive for developing nations, which triggered debt crises in Sri Lanka, Pakistan, Ghana, and Egypt. 12 people in Washington made a decision, and millions of people in Asia and Africa paid for it. That's the global economy. Not separate countries doing separate things. One machine. Unequally distributed. Unequally governed. Constantly moving. You woke up this morning. You made coffee. You touched the global economy 11 times before you left your bedroom. Now you know why. The Ethiopian farmer who grew those beans is locked into a commodity market that prices coffee in dollars they don't control, set by buyers they'll never meet on exchanges in New York and London. The cobalt miner in the DRC earns roughly $2 a day, supplying a critical input for a $400 billion phone market. The cargo ship that carried both moved through a choke point, the Suez Canal. That, when a single container ship got stuck for 6 days in 2021, cost the global economy an estimated $400 million per hour. You're not outside the system looking in. You're inside it. You always were. Here's the honest part. Knowing how the machine works doesn't automatically fix the machine. But it does mean you stop being surprised when it does exactly what it's designed to do. And it means you start making decisions about your money, your career, your vote, your attention, with the actual rulebook in your hands instead of the version they handed out in school. The global economy isn't a mystery. It's not fate. It's a set of human rules made by specific humans at specific moments in history for reasons that mostly benefited those specific humans. Rules made by humans can be understood by humans. Rules understood by humans can, eventually,
Be changed by them. If you got value from this, hit subscribe. We break down business, finance, and economics every week. No textbooks, no jargon, just the actual mechanics. Drop a comment. What should we explain next? Thanks for watching. See you in the next one.